Welcome to our comprehensive guide on what is a corporate bond. If you've ever been curious about how corporations raise capital or how corporate bonds work, you're in the right place. In this video, we'll demystify the world of corporate bonds, from understanding their basics to exploring the critical factors that influence their pricing and investor appetite. But that's not all. We'll also delve into the fascinating world of bond ratings and the difference between corporate bonds and stocks, shedding light on why corporations choose to issue bonds as a form of debt financing. Stay tuned till the end to gain a comprehensive understanding of corporate bonds. And if you find this information valuable, don't forget to hit that subscribe button to stay updated with our latest content. Let's embark on this enlightening journey into the world of corporate bonds together. Bond financing. What is a corporate bond? A corporate bond is a type of debt security that is issued by a firm and sold to investors. The company gets the capital it needs, and in return, the investor is paid a pre-established number of interest payments at either a fixed or variable interest rate. When the bond expires or reaches maturity, the payments cease and the original investment is returned. The bond's backing is generally the company's ability to repay, which depends on its future revenues and profitability prospects. In some cases, the company's physical assets may be used as collateral. Understanding corporate bonds. High-quality corporate bonds are considered a relatively safe and conservative investment in the investment hierarchy. Investors building balanced portfolios often add bonds to offset riskier investments such as growth stocks. Over a lifetime, these investors tend to add more bonds and fewer risky investments to safeguard their accumulated capital. Retirees often invest more of their assets in bonds to establish a reliable income supplement. Corporate bonds are generally considered to have a higher risk than U.S. government bonds. As a result, corporate bonds' interest rates are almost always higher, even for companies with top-flight credit quality. The difference between the yields on highly rated corporate bonds and U.S. Treasuries is called the credit spread. Corporate bond ratings. Before being issued to investors, bonds are reviewed for the issuer's creditworthiness by one or more of three U.S. rating agencies: Standard & Poor's Global Ratings, Moody's Investor Services, and Fitch Ratings. Each has its own ranking system, but the highest-rated bonds are called AAA-rated bonds. The lowest-rated corporate bonds are called high-yield bonds due to their more significant interest rate applied to compensate for their higher risk. These are also known as junk bonds. Bond ratings are vital to alerting investors to the quality and stability of the bond in question. These ratings consequently greatly influence interest rates, investment appetite, and bond pricing. How corporate bonds are sold. Corporate bonds are issued in blocks of $1,000 in face or par value. Almost all have a standard coupon payment structure. Typically, a corporate issuer will enlist the help of an investment bank to underwrite and market the bond offering to investors. The investor receives regular interest payments from the issuer until the bond matures. At that point, the investor reclaims the face value of the bond. The bonds may have a fixed interest rate or a rate that floats according to the movements of a particular economic indicator. Corporate bonds sometimes have call provisions to allow for early prepayment if prevailing interest rates change so dramatically that the company deems it can do better by issuing a new bond. Investors may also opt to sell bonds before they mature. If a bond is sold, the owner gets less than face value. The amount it is worth is determined primarily by the number of payments still due before the bond matures. Investors may also gain access to corporate bonds by investing in any number of bond-focused mutual funds or ETFs. Why do corporations sell bonds? Corporate bonds are a form of debt financing. They are a significant source of capital for many businesses, along with equity, bank loans, and lines of credit. They often are issued to provide the ready cash for a particular project the company wants to undertake. Debt financing is sometimes preferable to issuing stock rather than equity financing because it is typically cheaper for the borrowing firm and does not entail giving up any ownership stake or control in the company. Generally speaking, a company needs to have consistent earnings potential to be able to offer debt securities to the public at a favorable coupon rate. If a company's perceived credit quality is higher, it can issue more debt at lower rates. When a corporation needs a very short-term capital boost, it may sell commercial paper, which is similar to a bond but typically matures in 270 days or less. The difference between corporate bonds and stocks. An investor who buys a corporate bond is lending money to the company. An investor who buys stock is purchasing an ownership share of the company. The value of a stock rises and falls, and the investor's stake rises or falls with it. The investor may make money by selling the stock when it reaches a higher price, collecting dividends the company pays, or both. Investing in bonds makes an investor pay interest rather than profits. The original investment can only be at risk if the company collapses. One crucial difference is that even a bankrupt company must pay its bondholders and other creditors first. Stock owners may be reimbursed for their losses after all those debts are paid in full. Companies may also issue convertible bonds, which can be turned into company shares if certain conditions are met. Key points. A corporate bond is debt issued by a company in order for it to raise capital. An investor who buys a corporate bond is effectively lending money to the company in return for a series of interest payments, but these bonds may also actively trade on the secondary market. Corporate bonds are typically seen as somewhat riskier than U.S. government bonds, so they usually have higher interest rates to compensate for this additional risk. The highest quality and safest, lower-yielding bonds are commonly referred to as AAA bonds, while the least creditworthy are termed junk. Contact us today for more information.